is one of the largest electric vehicle companies, but many people think of it more as a technology company with strong R&D capabilities. Today, we will start with Tesla's brief history, discuss its strategy and organizational behavior challenges, followed by the impacts on its financial performance, and finally offer our recommendations to increase Tesla's success. Tesla was founded in 2003. In 2004, Elon Musk joined Tesla as an inventor. In 2006, Tesla's first car, the Roadster, was revealed to the public. In 2008, Elon Musk became CEO and was recognized as a co-founder of Tesla later. In 2010, Tesla went public. In 2020, in the middle of the pandemic, when most companies went through a harsh winter, Tesla finally became profitable for the first time.
Since its conception, Tesla's strategy has been consistent. Initially, Tesla, a small company, built a luxury sports car, the Tesla Roadster, in 2006, from which were successfully sold 3,000 units. Then, Tesla used that revenue and publicity to build an even more affordable car, Tesla S and Tesla Y, in 2012. Afterwards, Tesla continued to raise capital and develop an even more affordable car, Tesla 3 in 2017 and Tesla X in 2020, that generated even more cash. And finally, in 2016, Tesla decided to acquire SolarCity and invest into the energy generation and storage industry.
Now, how does Tesla play in the electric vehicle market? The pattern is quite evident now. The heavy investments made in Tesla were directly injected in the R&D for almost a decade. The aim was to develop more sophisticated technology for their products. This made it difficult for the competitors to imitate Tesla cars. Tesla decided to differentiate its products within the electric vehicle market by increasing autonomy of batteries in their cars and selling customized vehicles much more than competitors did. They also added autonomous driving features to the car and have built a big brand recognition and loyalty that made the differentiation even stronger. This led to Tesla gaining sustained competitive advantage in the electric vehicle sector, which further allowed the company to generate positive operating cash flows since 2018 and positive net income since 2020. Yes, even during the pandemic. However, since 2014, Tesla has opened its patents to its competitors, meaning that it is easier for competitors to imitate its technology.
The EV market, including battery EV and plug-in EV, is a very competitive market. Tesla is the market leader with 15% of market share, followed by Volkswagen 10% and SAIC 7%. Dozens of other companies make the rest of the market. Even when the market is highly competitive, Tesla has managed to increase its net profit, particularly in the last 7 quarters. They have recorded positive numbers in the bottom line 3% in 2020 and 10% in 2021, outperforming all their competitors in that key measure. However, the game is changing. As mentioned before, Tesla has built its competitive advantage through investing in research and development. From 2013 to 2017, the ratio of R&D spending to revenue remained around 50%, 3 times the industry average. But since 2018, Tesla has been investing in R&D around 5% to 8%, just as the industry average. Then there's a problem. How is Tesla going to sustain its competitive advantage?
From its founding, Tesla has been synonymous with innovation. This has required employees at all levels to consistently push boundaries and achieve lofty goals set by leadership. When problems arise, employees are expected to solve them quickly and still meet target deadlines. A combination of setbacks and attempts to push the boundaries too quickly has led to internal issues that need to be addressed for Tesla to continue to move forward. Management demands on employees have resulted in an inefficient workplace. Inconsistent strategic plans and messaging to employees have caused confusion and frustration as frontline workers are often left without guidance from executives.
Current conditions have caused consistent employee turnover, resulting in significant loss of talent and knowledge, further contributing to the inefficiencies of the company. In fact, average tenure at Tesla is just 2.2 years. When you examine the culture, it's clear to see that there are issues contributing to these inefficiencies. First, there's a perception that the company will put the profit before the well-being of employees. This can be seen as Elon Musk mandated that employees are required to work more hours at the factory in Fremont, California. In August 2020, he required that employees now work for 6 days every week for 60 hours, despite being in the middle of a pandemic and navigating hazardous conditions due to devastating wildfires. Further, there are several former leaders within Tesla that have disagreed with Elon Musk and as a result have left Tesla and began their own companies that are now in direct competition with Tesla. The impact of an inefficient workplace is not only felt by employees, it's also felt by customers. A prime example of this is the release date for full self-driving software being announced and then subsequently delayed several times. Employees are left trying to keep up with the latest company plans, and consumers are left wondering when the promises made by Tesla will be fulfilled. Uncertainty doesn't end with product release dates. Fans and foes alike are constantly waiting to see what Elon Musk will tweet next. With over 60 million followers, Musk has an undeniable influence that has seen Tesla's value rise and fall with just one tweet. Beyond the company's share price and value, Musk's tweets have led to investigations into both himself and Tesla. Finally, as Tesla is expanding its global presence, the public is waiting to see how the company will react to different cultures. Recently, when Musk was in Germany to open his Gigafactory, an environmentalist group expressed concerns about the water usage that would be required for the factory. Instead of answering the question, Musk laughed it off. This not only alienates potential customers and employees, it also sends mixed messaging as Tesla was founded on environmental concerns. Another major problem within Tesla is their lack of diversity, particularly in leadership positions, which includes directors and above. In fact, an impact investor stated that Tesla does not fall into the category of being highly diverse, inclusive, or a great place for workers to work. This is further evidenced as just this month, a court ordered Tesla to pay a former employee almost $137 million in a discrimination suit, which alleged racial harassment in a hostile work environment. Further, in December of 2020, Tesla released their first diversity and inclusion report, which did not include as many details as similar major tech giants. High findings do show that 83% of Tesla's leadership is run by men, 75% of all new hires in 2020 were male, and 77% of all promotions in 2020 were also given to men. The 3 senior leaders listed on Tesla's website are all male, and only 2 of the 9 current board members are female.
Moving on to the financials of Tesla. Now, Tesla has been the darling of the capital markets for a long time now, but behind the buy at any price story, there is some grim financial realities. Our first concern is the fact that the recent growth in Tesla's profitability has been driven predominantly by the sale of regulatory credits. Now, the CFO of Tesla himself believes that the sale of this credit is going to slow down in the future. This was not helped by the fact that Tesla lost one of its biggest customers of regulatory credits only a few months back. Tesla's current market capitalization and indeed its financial performance is heavily dependent on the growth the company delivers. Being an automotive manufacturing company, it has obvious benefits from economies of scale, and with increased volumes, we have seen that the company has turned profitable towards the end of 2019. Having said that, as of now, Tesla's productivity is 77%, and they are operating in a major demand surplus environment. This means that they are not only losing out on revenues and margin opportunities, they are losing out on opportunities for internal cash accruals, which can be deployed for later capex. The majority of Tesla's volumes have been driven by their growth in the mass market segment. If we look at their premium segment, which is the Model S and the Model X, both their volumes have remained stagnant over the past few years. With new launches in the premium category, like the Tesla Cybertruck and the Tesla Roadster, we may see a lot of improvement in brand building, but it does not really help accelerate the volume growth the company is targeting for.
Taking into consideration Tesla's history, past strategies, internal organizational issues, financial aspects, and relationship with markets, Tesla has 3 strategic options moving ahead. One says to keep it as a premium niche company as it was born. In fact, the average Tesla client is a high income middle aged male, which means the strategy will focus on that customer type. Or they could try to be a premium and cost efficient company at once, mimicking what some generalist car manufacturers have done, but with results. At last, Tesla can go all once for cost efficiency, volume, and mass production, trying to obtain a competitive advantage built upon economies of scale and vertical integration. This strategy includes increasing the number of supplies that are internally developed by Tesla. And our choice is to go for cost efficiency and volume. The electric vehicle market is expected to grow at an annual rate of 20% by 2030, generating a revenue of 1206 billion USD. In that huge market, Tesla can manage to sell 5 million units, meaning a growth of 26% CAGR that will increase the market share from 15% to 23% and generate an additional revenue of 237 billion USD.
However, a question remains. Why does Tesla should be producing 5 million units in 2030 instead of 10 or 20 million units? First of all, the 20 million unit figure, suggested by Musk years ago, implies raising an additional equity of $100 billion that exceeds the current value of the outstanding shares in the market, $86 billion. Moreover, the 12 million number is financially possible given the cash that Tesla currently has and is expected to have. However, the more than 20 gigafactories necessary to be built to achieve the goal poses a huge burden on the organizational sphere for Tesla. Finally, from a more realistic point of view, a 5 million figure makes more sense. It still implies rapid growth, 26% annually, that outperforms the industry, 20%, reaching a quarter of the market share by 2030, allowing the company to organically grow while addressing the organizational issues. To keep with the growth, we suggest that Tesla should invest the excess of cash from the automotive business unit into the energy generation and storage business units, which are still growing. In our view, extra cash coming from the automotive sector, around $25 billion in the next decade, should be invested in the energy generation and storage business unit, which is part of an industry that will have a combined revenue around $800 billion by 2030. Tesla right now produces the best batteries in the automotive industry. Additionally, the energy industry faces a bottleneck regarding energy storage. Having that into consideration, Tesla, through heavy investments in R&D, is in the best position in the market to address the battery problem. Tesla has the knowledge, the human resources, the tech problem-solving mindset, and the cash to disrupt this market by improving the quality of batteries. In fact, Tesla has been doing partially so by acquiring battery companies since 2017. Moreover, alongside the other investments in solar panels, Tesla can achieve a vertically integrated business model by generating energy with solar panel products, storing it in batteries, and use it in Tesla Habitat and Tesla cars.
By establishing clear goals, we believe that this will set the table for leadership to address the issues of their unclear vision and inefficient workplace. With the refined vision, Tesla will be able to set clear expectations and build a roadmap for employees. They will need to focus on avoiding unrealistic timelines and allow employees a regular work-life balance. By making Tesla a better place to work, they're likely to see a positive impact on the retention of their top talent. Addressing diversity will be another key component for our plan. Tesla needs to work to continue to elevate the women they have within their company and work to bring on additional diversity into leadership roles. Tesla has already stated that they will focus on college recruitment, targeting a diverse group of new employees. We'd like to see them follow through on this plan, as well as investing in programs such as Women in STEM. Additionally, Tesla will need to ensure that the cross-functional teams formed to execute on our proposal are a diverse group of their current employees. To summarize, Tesla is a company that faces tough choices in both the strategical and organizational spheres, from which we broadly suggest the company to moderate its goals in the automotive market to improve the culture in the company and invest the excess of cash in the energy generation and storage business unit.